And good afternoon. Welcome to Camaplan's Basics on Self-Directed Investing, one of the most effective tools to build generational wealth. I'm Joe. I'll be with you for the next half hour. And let's get started. First, a disclaimer, the lawyers have to have their say. We don't provide investment advice. We can't recommend or promote or encourage any type of investment. We're custodians. So everything you hear today is provided just for educational purposes. We always tell people to consult their financial advisors, accountants, CPAs, tax preparation specialists, attorneys if necessary, before they do anything in the self-directed area or anything else. Bit about us. We've been doing this for more than 20 years. We're north of Philadelphia in lovely Ambler. It's a suburb. We've got about 8,500 clients across the country. Currently have 1.1 billion with a B assets under management. And we're big enough to get anything done, but small enough to answer the phone. And that's why we pride ourselves on our service. When you call in here, you're going to talk to me, you can talk to Courtney or Matt, and we'll all help you get done what you need to get done. I spend most of my time talking to private equity, private lending, and venture capital folks and making this whole process of using IRA and 401k money easy from their perspective. But today we're going to talk about you as investors doing this. We're big on education. That's why I'm here today. And we also have at the website a library of very informative and useful webinars. So you want to check that out. And they're also downloadable reports. A bit about the founders, brother and sister team. They are a third generation real estate family. And they like to say that they found Camaplan by investors for investors, because that's what they've been doing. The Cama comes from the first letters of each first name, Carl Fisher and Maggie Polisano. Carl is a rocket scientist, actually, and worked on the NASA Space Shuttle program and worked with a number of space contractors before committing full-time to this. Maggie has Fortune 100 IT platform experiences and has built out all of our technology platforms that we use to manage day-to-day operations and your accounts. What do we do? Well, every IRA or 401k has to have a custodian. So we're no different than Schwab or Fidelity or Vanguard. We're a neutral third party. Again, we don't provide any advice. We don't sell anything. We'll keep you clean with the IRS, though. That's what we're here to do. And we keep records of everything. We're basically the ledger that accounts for all of the activity that goes on inside of your IRA or your 401k. We send documents to the government, and we send documents to you to give you your tax prep specialist and keep you clean with the IRS. We also work with your other team members. You have a tax prep specialist or a CPA, and we recognize that we're just part of your financial picture. So we want to make sure that what we do over here with you fits into what your professionals are advising you to do. So that's our role in this whole thing. We're going to go through a few things here. We're going to talk about what self-direction is, different types of accounts that are self-directed, and there are quite a few of them. The types of investments you can do, the stuff you're not allowed to do and who you're not allowed to do it with. And then we're going to look at an actual investment inside of an IRA versus the same investment outside of an IRA. And we're going to look at the performance difference. Then after we show you the ropes, we're going to show you how you get started. So this will be pretty easy. And of course, pop any questions into the chat box. Let me see if I've got it here. And I'll answer any questions you have. If I don't have an answer for your question today, I'll get one and get it to you. So let's get started. There's a lot of talk about what is and what isn't self-direction. I mean, Schwab and Fidelity and Vanguard are self-directed in the sense that you select the securities that you invest in, but they focus on listed securities. That's stocks, bonds, mutual funds, ETFs, things like that. I've got an account over at Fidelity. I love it. And I like the idea of being able to put in a sell order at 9 o'clock before I go to sleep and wake up the next morning and it's done. We handle everything else. all of the different asset classes and investments that you can make that are outside of the listed security area. So we believe that we give you true self-direction, and we have a broader latitude than the traditional brokerage houses. One of the great attributes of self-direction is that you can invest in what you know, and you have more control over your investments. We get a lot of people from their mortgage brokers, their accountants, their real estate agents. They were in construction and maybe worked on a fix and flip. So they bring their expertise to the table. We also have a lot of people who have spent decades in industries that they're now free to invest in and invest in knowledgeably once they retire. Let's talk about the different kinds of accounts. Many of you are familiar with the accounts on the left-hand side of this slide. That is a traditional IRA where you put money into it and you get a deduction. The government pats you on the head, gives you an attaboy or an attagirl for putting that in there, and they're encouraging you to put money away for retirement. They're also subsidizing that, and I'm going to come back to that in a minute. There are different variations of the IRA traditional. The spousal or inherited is something that happens when someone passes who owned an IRA account. The simple SEP, defined benefit plan, and defined contribution plans are what businesses use. It's a form of IRA for businesses. The SEP stands for Self-Employed Pension IRA. The simple plan has a longer acronym, which escapes my memory at this point. But these are plans that you can put on top of a small business and an S corp. If you've got a side gig and you're looking to get into investing, put your toes in the water, these are great plans to set up that allow you to put away substantially more each year than you would be able to put away in a traditional IRA. And the defined benefit plan is what we used to call a pension. They still exist. And the defined contribution plan is the 401k, which many of you have had contact with through employer plans. The key on this side is that because the government subsidizes your savings, they're in essence subsidizing your seeds, and you're going to plant them, you're going to water them or pray for rain, you're going to deal with blight, you're going to harvest it, you're going to take it to market, you're going to sell it, and at the end of the day, the government's going to want its share. So you're going to pay taxes on the distributions when you finally start to take them after 59 and a half. And the idea behind this was that when you retire, you will likely move into a lower tax bracket. And so taking funds out of these accounts, you'd be taking them out and paying taxes at a lower rate. Another thing about these accounts is that you'll be required to start emptying them out. Right now, it's at age 73. In 2033, it's going to go up to 75. So the key here is you're being subsidized. You're going to share your profits with the government in the form of income taxes when you take it out, and you'll be required to take it out. The other side of the ledger is the tax-free side. We really like these. This is the Roth IRA, which operates just as a traditional IRA does in all respects, except that you're not getting an attaboy or an attagirl for putting money into them. This is after-tax dollars that are put into these accounts. A variation of it is the health savings account. Another is the education savings account, great for putting away money for college or for trade schools or for whatever it is your kids want to do. And then you can also have a 401k that behaves like a Roth. Now, the key here is that you're putting all the money in, so you get to keep it all. All right. There's no taxes on distribution, and there's no required minimum distribution. You can let this thing go on and give it to your heirs, which you can do with the tax-deferred IRA as well. And they'll be required to start taking distributions once they get that. Probably the most prolific example of someone using a Roth is Peter Thiel, one of the founders of PayPal, who put his PayPal shares into a Roth, and he has somewhere north of $1 billion with a B in his Roth IRA that he'll never pay a dime of taxes on. So it's a very powerful vehicle for wealth accumulation, and we'll show you exactly what that means in a second here. I think one of the upcoming slides has that. What can you invest in? Well, virtually anything. Fortunately, the list of things you can invest in is very short and very clear. But the most popular asset classes that we deal with are real estate and real estate adjacent investments. Now, the first couple here, the first four, our rental properties, apartments, condominiums, single and multifamily homes, and commercial property. That would be retail and office. But we see people investing in land banking, that's putting away land, investing for future development. We see people investing in land that's prepared and sold to single-family home developers. It's a very popular investment. And you're not limited to the United States. You can invest overseas as well. We have people investing all over the world. There's also storage facilities and all the different assets that are related to it. If you've seen mobile home parks, recreational vehicle parks, glamping, which is the glamorous camping, that is all being packaged as an investment. I listened to an interesting presentation earlier this year from someone who's doing it with marinas. And so these are all investment opportunities related to real estate. I tend to focus on the passive. I don't have the capabilities and temperament for being a landlord and owning property directly. So I stick with passive investment. I'll loan to fix and flippers. I'll buy and sell mortgage notes. I'll put money into funds that invest in real estate. So I like the passive stuff. And I like it because it's tied to a piece of property. Normally, under the circumstances where you're lending money on a real estate deal directly with the borrower, you're getting a lien on that property. I like that form of safety. But I also invest in funds that invest in real estate. There's one that is a note pool. In other words, it buys mortgage notes and manages those notes and shares the interest payments or shares the profits from those mortgage notes with me. We see every corporate structure imaginable except for the S Corp. A lot of people invest through funds, again, because it's passive. You do your homework once and checks flow back into your IRA. Probably the third or fourth largest investment class for us is precious metals. And this isn't like the ads you see on TV where, they say you can hide it under your bed or in your toilet tank. This is gold and silver, palladium and platinum held in your name at a depository. We work with 2 depositories here on the East Coast, and those metals are held in the name of this company. And if you want, you can have those metals held in your name specifically. A little bit more detail on the asset classes. Again, the first floor for rental. We have people investing in the foreign property area. We have some people investing in Colombian coffee plantations and Costa Rican vacation properties. I mean, it's, the choice is yours. Again, mortgages and promissory notes. We like this. Let me say a word about unsecured lending. I have a friend I've known for a really, really long time. He has a business that requires significant capital up front to acquire what is, in essence, the raw materials for his business. And he adds value to those raw materials and he sells them and then he shares the profit with me. We've been doing it for 10 years. So that's another form of lending that you can do and out of your IRA or your 401k. Again, every corporate structure. We're seeing a lot more in the way of investment clubs. That is people like you getting together with other investors with similar interests and investing together. And sometimes when you do that, the sponsor of that investment will sweeten the pot a little bit for you, maybe offer you an extra percentage point of interest. So we see a lot more of that now. We also see people who are solid in the traditional asset classes that we've dealt with. They own a portfolio of real estate, or they have portfolio of notes or investments in funds. And now they're looking to the venture capital side, and they're looking at some of the things that offer 3 and 5 and 10x on their investments. So we see more of that going on these days, interest in ventures. Okay, this being the IRS, certain things you can't do. I mentioned earlier, really it boils down to just collectibles and life insurance. So, you can't put the Persian rug in there or, Civil War currency or Roman coins or any of that kind of stuff. Anything that's collectible. And the reason for this is that the valuations can vary dramatically. And when it comes to valuing the assets in these accounts, they have to be accurate, particularly at the time you start taking distributions. When you're required to take them, they want an accurate valuation. Or if you're going to move assets from a traditional IRA into a Roth IRA, you'll want to have a very accurate appraisal. And these appraisals can be all over the map, depending upon, you can shop around and get an appraisal for these, in any fashion that you want. No firearms, and no collectibles of any kind, no booze. So that bottle of Chateau Petrus 61, you'll have to just consume that. The big exemption with regard to coins, again, the numismatics you can't keep in there, are the sovereign minted coins. And that would be the Chinese pandas, Canadian maple leafs, the South African cougarans, and of course the American eagle, which is my favorite. So again, these you would find a broker. Your IRA would make the purchase. We would handle the paperwork and the movement of the metals to a depository. Again, this being the IRS, there are some rules about who you can do stuff with. And I'm going to make a differentiation between investing in and investing with. All right. For whatever reasons, you cannot invest in investments that are operated by any of the people in the blue boxes. So your parents can't invest in your company. You can't invest in your wife's company. You can't invest in your children's company. But every one of the green boxes is fair. You can do that. And I'll give you one example. My nephew operates a specialty welding operation in Texas. And this is high spec pharmaceutical and oil field welding, stainless steel stuff. And when he first started out, he didn't have the financial records or the 2 years of financial statements that he could take to a lender and get some financing. And so he asked me if I could do it. And I did. I was able to lend him the money that helped jumpstart his business. He paid me back, and he paid me back with interest. So I made a little money on it. And long and short of it, he doesn't need my money anymore. So he takes me to dinner when I go visit him. So that's something you can do. And that's a real big part of getting started in this, is your circle of friends and family who believe in what you're doing. They may not have 20 or 30 or 50 or $100,000 sitting around doing nothing, but they might have an old 401k or an old IRA that isn't doing anything. And you can put that money to work, earn them a good return, and jumpstart your business. Now, I made the distinction between investing in and investing with. You can invest with anyone on this chart. Now, I'll give you an example. My wife and I invest in mortgage notes, and we invest in lending in general. And if we find a loan we want to do, and I might have 30% of it, and she might have 70% of it, we can go in as partners. In other words, I'm not investing in her, she's not investing in me. We're investing in and buying the note. So you can do that. And it's very popular for, I have some coworkers I do it with. I have some friends I do it with. And of course, family members. I've shown them how to do this. And so I can go out and find an investment, and they say they're not interested in learning about it. They don't really want to know how it works. Pay no attention to the man behind the curtain. But you can pool that money and go after bigger deals than you otherwise would be able to by yourself. At the end of this thing, there's a QR code that you can use to get a report called 20 Ways to Fund Your Next Investment. And it talks specifically about how you can do that. There's one more area of limitation, and that is just no self-dealing. We get a lot of people who come in and say, well, can I buy a house that I own? You can't do that. You can't be on both sides of a transaction with your IRA. When it comes to business ventures, you cannot be a majority shareholder. You cannot own 50% or more. You can't control the company where you say own 5% of the shares, but you're really the spider at the center of the web calling all the shots, or taking compensation. You'll want to consult your tax prep specialist and your CPA when you get into anything like this. I'll give you probably the two most frequent examples we get is parents that come with a son or a daughter that's headed off to State U, and they want to buy a condo, rent out the bedrooms, and son or daughter gets to stay free. Unfortunately, you can't do that. So because that's self-dealing. And same thing with vacation properties. People think, well, I'll buy this with my IRA, and I'll go down there 2 weeks a year, and you can't do that. So you can't really touch the property. We have a saying that you can pick out the paint, you can pick out the tenants, you can pick out the paint color, but you can't paint the house. So no self-dealing on that. And people say, well, who's going to know? Well, you don't want to tempt fate. The penalties are too steep. Divorce, falling out with a neighbor, that sort of stuff. How is this possible? I mean, why does this work this way? Well, those of us who've made our livings as 1099 contractors like me, or W-2 employees like many of you might be, pay a lot of taxes. I mean, just look at it. You know, you make $100,000, you get to keep 60% of it. In some states, you're keeping less than that. But as you move up the food chain, so to speak, towards more passive forms of investing, you pay less tax. And so things like royalties and capital gains, you're paying at a lower tax rate. And you're not paying all the Social Security and Medicare, all that stuff. When you get into the IRAs, you get to keep all of it. Now, in the tax deferred, the traditional IRA, you'll pay when you start to take that money out at the tax rate that you pay in the year that you take that distribution. So when you're 63, you're still maybe earning a little money, you're going to pay taxes on that. Whatever that tax rate is going to get applied to, to this. The tax-free, again, you're going to keep all of it, and the tax man won't see a dime. You can look at it another way. In this chart, every year the tax man or tax woman comes and takes a big bite out of what you're making. And so at the end of the day, after decades, you end up with a lot less than you would if you were putting it in one of these vehicles. The tax deferred at least allows you to accumulate all of that faster and without interruption, so that at the end of the day, when you're ready to start taking distributions, you have a lot more money. Look at this. It's essentially double, right? And then if you're putting it in the Roth IRA, you do your investments there, you're essentially 3 times wealthier, if I do my gazintas right. So this is really powerful. Let's take a look at how this actually works on a real deal, all right? Let's just say there's 2 buildings, identical in every way, built the same year, maintained the same way, owned by 2 different people. One of them has an IRA, and one of them does it with non-IRA money. On the right side, there's going to be the income is the same for both. Let's say on the right side, that owner gets a depreciation allowance. And we put some assumptions down here based upon actual experience with investments. Now, they're going to get a depreciation allowance, which is great. It's one of the big reasons people get into real estate. But they're going to pay taxes on the income, on the adjusted gross income for that property. Now, one thing that's missing here, and we really couldn't find a fair way to do it, is there are expenses associated with operating this property as a rental property. They're going to be deductible, and we understand that. The point is that you're going to end up with less, whereas the IRA, in the building in the IRA gets to keep all of that income. Now, we have it here as a Roth, but you would still get to keep that income in a traditional until you took distributions. But the real magic happens when you go to sell a property. And I think we put in the 10 years. 10 years is right here in the assumptions. Say it sells for $3 million. You're going to have depreciation recapture and capital gains on the right-hand side, which is going to lower the net proceeds. And it's a significant lowering of net proceeds. And so at the end of the day, the owner in the IRA ends up substantially ahead of the non-IRA owner. So all of that $3 million goes right to the bottom line. And if it's in a Roth, you'll never pay a dime of taxes on it. So you see how really powerful this is. A couple of things about managing property in an IRA. The IRA will be the owner of the property. And because it must be a passive investment, everything is done through the IRA. You can't touch the property, as I said earlier. And most traditional landlords have a little problem with this. They're used to doing stuff on their own. But as they build out their portfolio of doors, as referred to in the business, they're going to end up with electricians and carpenters and plumbers and people to do the work on those properties other than themselves. So as I said before, you can pick out the paint color. You can't paint the house. The owner of the company, Carl Fisher, tells a story about missing out on a chance to bid on a property he'd been watching for months and months and months. And he missed out on it because he was busy saving himself $25 an hour painting one of his other rental properties. And so if you're serious about building a rental property portfolio, again, this is hands-on type stuff, you're going to end up with a cadre of professionals that are going to take care of this. So the IRA ends up paying the gas bill, unless utilities are paid by tenants. They pay the tax bill out of the IRA. The contractors are paid out of the IRA. Everything is paid out of the IRA, and everything comes back into the IRA in the form of rent. So one other anecdote that Carl likes to tell is that when he goes into one of his properties, it's almost as if somebody has to duct tape his wrist together. So he's not tempted to monkey around with anything in those houses. So it's just a different mindset. And I bring this up because I speak to a lot of landlords, and that's one of the things that they're not accustomed to. So, all right. So we've talked about what they are, what self-direction is, the types of accounts that are self-directed, the kind of assets you can invest in, the kind of assets you can't invest in, who you can invest in, who you can't invest in. And with all of that, how do you get it done? Really, this slide could be boiled down to 3 steps. You're going to open your account, you're going to fund your account, and you're going to make an investment. And we can help you with all 3 of those steps. So if you have an IRA, already have one somewhere, and you want to move those funds over here, you would open a similar account, a traditional to traditional, or a Roth IRA to Roth IRA, and that money would be transferred. And the great thing about this 3-step process is that when you open your account, part of it will be telling us about the transfer that you want to make. So you'll have accomplished the first 2 steps in about 20 minutes. So Roth to Roth, traditional to traditional, those are transfers, and we initiate those on your behalf. If you've got an old 401k, you got a 403b, you got a teacher's savings program, a pension, those are handled a little bit differently. You would open your account the same way you would with the others. You would tell us about the rollover that you're going to do. Instead of a transfer, it'll be a rollover. And then we'll help you in terms of giving you what you need to go back to the custodian where your account exists and initiate the rollover from there. So once the transfers or the rollovers are initiated, it takes about 2 weeks for funds to arrive. So you'll want to factor that in if you're thinking about making a real estate transaction of any kind out of your IRA. It takes about 2 weeks. So you've got an investment of about 20 minutes, maybe another 20 minutes if you're doing a rollover with your other custodian, and you're waiting 2 weeks for the funds to arrive. Once the funds are here, you're free to invest. And that generally entails getting the documents prepared for a sale of property to you or to your IRA, or an investment in a fund, or a loan documents associated with lending to someone, and getting that paperwork executed, and then submitting it with a purchase directive here. And the purchase directive tells us how much to send to who for what reason. And we'll help you with each one of these steps. We can get on a 2-way call. We can do shared screen. We don't want you to flounder around and wander around and not know how to complete this stuff. So it's a very simple process. There's a couple things I'll leave you with. And again, if you have questions, don't hesitate to put them in the chat box or to send them to us. We'd be happy to answer those. This is a report we prepared some time ago, and it's one of our most popular. And if you hold your phone up to the screen and use this QR code, you'll get it. And it talks about innovative ways to assemble the funds you need to make a real estate investment when you don't have all of the money for the entire purchase or the entire investment. Your IRA, for example, could take out a loan. It's called a non-recourse loan. You can use your IRA to do the down payment and then use the loan to finish acquiring the property. And there are some rules and regs on that, but I can show you that, or any one of the Camel Plan team members can show you that. So this is a good report. And there's 2 other things I'll leave you with. One is there's a little 5-minute illustrated video here if you use your phones to get this QR code. And in 5 minutes, it does what I've spent the last, 30 minutes talking about. So you want to get that as kind of a refresher. Again, at the website, you'll see a full-length 101. It's a little bit more detailed than what I've gone into here. All right, so you'll want to visit the website. Go to the webinar section or the event section, go to past webinars, and you'll see them all there. We also have a podcast called The Road to Financial Freedom, where we discuss the journeys that investors like you have taken. Some investors have come in as rookies and newbies, and they've assembled a portfolio, and then they've decided to get big, and they decide to raise money and take off and make a career out of this. So anyway, that's me. Again, feel free to send any questions that you have to Engage at Camoplan, or call us here at the office, and you can ask for me. And if I'm not here, which is frequently the case, they'll put you together with somebody that can answer your questions and get you started. So I hope this was useful for you. I thank you for spending time in the middle of the day with us. Good luck with whatever you're doing.